Canada's financial health is taking a hit from the coronavirus pandemic. Fitch Ratings has downgraded the country's long-term foreign currency debt rating. It was a AAA. It's now AA+. The agency cited the federal government's move to borrow about $250 billion to prop the economy up during the pandemic lockdown. Fitch Ratings also said that while it is downgrading Canada's rating, it expects Canada's debt to GDP ratio to stabilize over the medium term. Finance Minister Bill Morneau responded to the news today saying, quote, "Going into the global pandemic, Canada was in a great position to deploy our fiscal firepower to protect Canadians, and we have. A worst-case scenario for Canadians and the economy would have been not to act." The statement also goes on to say, moving forward, we will continue to be fiscally responsible while acting to protect our country and its economy. Well, this news today comes as the International Monetary Fund downgraded its outlook on the global economy, and the fund predicted that the global GDP will shrink by 4.9% this year. That's 1.9% higher than its previous prediction in April. The IMF is also predicting Canada's economy will shrink by 8.4%, 2.2% more than its last estimate. So, where's the Canadian economy headed? What does that look like in practical terms? Joining me for more on this is Pedro Tunis. Pedro is the chief economist for the Conference Board of Canada. Pedro, welcome back to the program.
Well, thanks for having me, Carol. Pleasure.
Let's put it into context for us. What do you make of the latest credit rating downgrade from Fitch?
Well, I think certainly it's a signal. It's a signal that at least one of the credit ratings out of the three is concerned about the amount of spending that we're currently embarked on. And they're just giving us a little sense that, they'd like to see perhaps, a plan to stabilize, or as they suggest, that they see that as stabilizing. So that's their expectation. And perhaps that's a hint to our own finance minister to, give us some light as to where we're headed perhaps down the road.
Do they really take into consideration, these credit agencies, whether we had a choice or not?
Well, so I do believe that obviously they're looking at this relative to other G7 or G8 countries, et cetera. And of course, those ratings do fall in line with that. We're still in very, very good shape with a AA+ rating. But, it's just a sense that they'd like to see, I can't speak for them, but I think it's a sense that they'd like to see where we're headed longer term. And I think we've been avoiding that. We've been really talking in the economic update that's coming. There's not a lot of long-term suggestions as to where we're headed. And I think in the past, the government has been, sticking to that declining debt to GDP ratio. We're going to take a big hit, obviously, with this spend that we're living through right now. But what is the plan longer term? And perhaps it's just a sense of, looking for that from the finance minister.
And when you say take a big hit, how does that manifest itself? What does that look like?
Well, essentially we've been at the federal level talking about a debt to GDP ratio. And again, it depends on what measure you're looking at. Here I'm talking about the net debt to GDP, which excludes the financial assets that we have. Essentially we're talking about 35% of GDP, and that in the plan prior to COVID was declining slowly over time, even though we're still running and planning for deficits. But now, of course, with the huge spend, a spend that's equivalent of about 10% of GDP, depending on, where the programs and the support measures land up, that'll add essentially, probably 10 percentage points fully to our debt to GDP ratio, perhaps even more. So, I think longer term, what we're looking at is what's the plan to stabilize that? And is there a plan to return to a declining debt to GDP ratio over the long term? And I think we are going to see that when we eventually do get a budget.
And when you talk about those numbers, what does that look like for the average Canadian? What does it mean for the citizen of Canada?
Well, I think right now, obviously, what we're seeing is a huge amount of support that's going to households, and I think they're through the emergency response benefit that has really helped a lot of Canadian households that have lost their jobs or seen their incomes disappear. So it's certainly been a measure that's been needed short term. Longer term, right now we're not too concerned about it because we do have a still fairly strong debt to GDP ratio. I think we are going to see the economy recover, and for households, because the interest rates are so low, I don't think that this rating will necessarily add a whole lot to our debt financing costs. So I don't think a whole lot will change for households right now. What they're sensing right now is essentially the support measures that are coming back into their pockets.
Yeah. What do you expect, you meaning the Conference Board of Canada and you as the chief economist, what do you think our recovery will look like?
Well, and you just talked about the IMF downgrading its forecast. We have done so as well, and I think the expectation early on when we first started looking at this was first to get a sense of how deep and how quick this was hitting us. We've gotten certainly a handle on that. We saw the numbers in April. We certainly believe April was the worst month, and we're going to start to see a recovery, and we're already seeing signs of that. The question now is, how fully do we get back to normal operations, normal capacity in a world where we're still very much at risk of the infection spreading? So this is going to be a very constrained economy until we come up with a vaccine or some sort of treatment. And we certainly assume, well, we're not experts on that piece, but we certainly are assuming that it's probably a year from now. So the real question is, over the next year, what does the economy look like? It'll recover. We'll come back as we open the economy. But again, this cost of operating at half capacity under this scenario is going to be tough for a lot of businesses for a long time yet.
Okay, so and at the end of the day, what do you think will stabilize our economy? You say it will come back, but how do we stabilize ourselves? How do we come back?
Well, again, I think a lot of it depends on essentially how quickly we reopen. We essentially are expecting that we're going to see nationally a kind of broadly, consistently opening economy. But there are going to be pockets where the virus strikes here. We expect that there'll be localized closures, et cetera. So it's going to be a bumpy ride for sure. And again, until we get that vaccine and this is fully behind us. So I think that's the key. One of the keys. The other key is, what are the support programs? And I think we do need to think about transferring away from the CERB and focusing more on the wage subsidy, because businesses are going to be operating in this very difficult environment for a long time yet. And I think they need, we believe that they'll need the support to be able to operate, profitably with this subsidy in place. And I think there may be more spending yet if we are going to see that happen.
All right. Pedro Tunis, Chief Economist, Conference Board of Canada. Pedro, thank you so much for joining us once again tonight.
Nice to talk to you, Carol.